Hey guys, welcome back. My name is Lorenzo, and the purpose of this channel is to make simple a word usually known to be as complex as the stock market. In my previous videos, I mentioned the concept of compounding, but today I want to dive deeper into why it is so powerful, especially when investing in stocks rather than bonds. Many investors overlook this fundamental concept, but understanding it can change your entire approach to investing. And by the end of this video, you'll see exactly why holding stocks for the long term is crucial for maximizing gains. But what is compounding? Compounding is when your investment earns returns, and then those returns start earning returns themselves. It creates an exponential growth effect, meaning the longer you stay invested, the greater your wealth accumulation. Here's the key takeaway. Compounding does not work the same with bonds as it does with stocks. Look at this graph, comparing the returns of stocks and bonds over the last century. Well, the difference is huge. Bonds provide fixed interest payments, which means your returns do not grow exponentially. Stocks, on the other hand, benefit from price appreciation and reinvested dividends, which allows compounding to take full effect. Now let's go to the Just ETF website. And let me show you an example using an S&P 500 ETF. Over the past 5 years, the total return including dividends was approximately 98%. The dividend yield of the S&P 500 is slightly above 1%, which means that over 5 years dividend contributed roughly 6% to the total return. If we subtract this 6% from the 98% total return, we get 92% rather than the 86% shown in the graph that excludes dividends. This 6% difference, 92% minus 86%, is due to the compounding effect, because in the first case, dividends are automatically reinvested, generating additional returns over time. But why holding stocks long-term matters? Let's look at a simple example to understand why compounding is so powerful. Imagine you invest in a stock that doubles in value, a 100% gain. Now consider the impact of a 1% additional gain after this increase. If you invested 1000 euros and made 100%, your portfolio is now worth 2000 euros. A 1% gain on 2000 euros adds 20 euros. Compare this to a 1% gain on your initial 1000 euros, which would have added only 10 euros. This means the more your investment grows, the greater the absolute returns you earn from the same percentage increase. This is why time in the market is crucial, because as your capital grows, even small percentage gains generate substantial profits. The power of compounding applies perfectly to dividends as well. If you're a dividend investor, this concept will be particularly interesting to you. Let me introduce you to yield on cost, a key metric for tracking dividend growth. Yield on cost is calculated by dividing a stock's current dividend by the price you originally paid for it. It's a valuable measure for investors focused on growing their dividend income over time. For example, if you buy shares of Coca-Cola today, you'll receive a 2.86% dividend yield. Now, let's say Coca-Cola stock price doubles while maintaining the same dividend yield. Not only does your investment double in value, but your dividend payout doubles as well, pushing your yield on cost from 2.86% to 5.72%. And if the company continues increasing its dividend over the years, you could eventually achieve yield on cost of 7-8% or more, for instance. That's a massive return, especially considering that a good dividend yield is typically around 3%. This is the power of compounding. Warren Buffett made a significant investment in Coca-Cola in 1988, acquiring shares for a total of approximately 1.3 billion. By 2017, this investment was generating around 500 million in annual dividends, representing a yield on cost of approximately 45%. This means that relative to his initial investment, Buffett receives a huge percentage of his original capital in dividends each year, thanks to Coca-Cola's consistent dividend growth over time. This is an extreme example meant to illustrate the power of the concept. Reaching these levels is incredibly difficult, but the principle remains the same. Even on a smaller scale, Dividend growth and compounding interest can lead to significant returns over time, allowing investors to build substantial passive income. This is why legendary investors like Warren Buffett emphasize long-term investing. Compounding rewards those who stay in the market and let their investment grow over time. If you found this video useful, make sure to like, subscribe, and comment below. Let me know what investing in topics you'd like me to cover next. I hope to see you soon.